Okay, folks, we're going to jump right in and wrestle this theory of inventories, or the theory of inventory costing, to the ground. And let's start with some terminology, and we'll talk about the physical inventory that needs to be taken. And what I'm saying on this slide is that even if a company uses a perpetual inventory system instead of a periodic system or process, they still need to take a physical inventory at the end of the period, typically at the end of the fiscal year. And the reason you do that is just to make sure, as a check of your records, if you're under a perpetual system, you need to make sure that you haven't had shrinkage, spoilage, or somehow the inventory grew legs and walked out the door. And so you need to take that physical regardless. Now, of course, on a periodic system, the word comes, you periodically have to take that physical inventory just in order to know how much you have on hand and to therefore be able to calculate your cost of goods sold during the period. So just know that you have to take that physical inventory whether you're on a periodic or perpetual system. And as a review, in a periodic system or periodic process, the company records purchases into the purchases account, but then they must physically take that inventory at the end of the period, hence the term periodic, in order to determine COGS for the period. And also to report inventory as an asset on the balance sheet. In the perpetual inventory system, the inventory count is updated every time there is a transaction, which would be debited for a purchase and credited for a sale. And realize that inventory is an asset, so remember from our basic accounting that we debit the asset to increase it and credit it to decrease it. But the word, perpetual just means you're perpetually keeping it up to date. That's the way to remember that. Now this slide shows some nice pictures, and I want to show you some more pictures and even draw for you in just a minute. But this is to depict both all of the methods taught in your book, which would be the FIFO, LIFO, and weighted average methods. Now what you're seeing here is you're having an inflow. These little cubes are falling in and they're laying on the top of the stack, okay? And so these are the goods that are recently coming in. Now the goods that are being sold are coming out of your inventory. If you view this box as holding your inventory, the very first items, which I know that may sound contradictory, but the first items are the oldest items. Think of it as the first in the chronology of your business or the life of the business. The very first ones, the ones down here on the bottom, are the ones that are coming out as you're selling goods in the current period. And hence the word FIFO, first in, first out. Or excuse me, the acronym FIFO. In LIFO, the last or the most recent goods that are coming in, again these ones on this top layer, are also assumed in this LIFO cost flow assumption. You're going to use the cost of those goods to represent the cost of goods sold as you sell your inventory. So as you might guess, is you have all of these old layers. These ones on the bottom may be really old and valued or on your balance sheet at whatever cost you paid way back when those goods came into your business. And we'll get into what inflation does in a LIFO assumption in terms of how it impacts cost of goods sold and your inventory balance. And weighted average cost, you can see, is just kind of in the middle here. It's not on the bottom like FIFO, it's not on the top like LIFO, but just the average of all of these, both the old early first purchases and the late last recent purchases. It's basically taking a weighted average and using that weighted average then to credit inventory and debit cost of goods sold as you sell your items. What I want to do now is a little bit of a freehand drawing, another way of just illustrating how the cost flow assumption works. So let me get into to an inking mode here, if you'll bear with me one second. Let me expand this a little bit. I need to get out of presentation mode in order to this to look okay on the recording. So if you picture just like a bucket. I know I like the term buckets. You've heard me use that before. And if you have like an inflow, pretend this is like a spigot here, and you've got water or whatever it is coming in. Now, if I draw an outlet from this bucket right here, if I tap into it to drain that bucket, I would ask you then, okay, this is the very top of it. What does this depict? And also assume that instead of water, which can be like a homogeneous type of product, but assume you have something that maybe creates a little bit of a layer here, so you got layers. But this depicts, if you've already thought about it in your head, is it LIFO, is it FIFO, is it weighted average? Remember, weighted average was kind of in the middle, so we can rule that out pretty quickly. Well, what this is LIFO right here. Last in, first out. So the very recent stuff that's coming in, this top layer is what is flowing out my inventory. So I've got, when I take inventory at the end of the period, I'm going to have all these layers here on the bottom that represent my inventory. So what I'm doing is I'm using inventory, or actually selling inventory. I am charging cost of goods sold, matching my revenue with that cost of goods sold with the cost that I'm most recently paying. And most people think this is a pretty good way to match, and it's conservative in terms of you'll have a lower gross profit during an inflationary period. Now, since I've already given you LIFO, you're probably going to be able to guess that when I draw FIFO, that spigot is going to be down here on the bottom, right? So I'll have this oldest inventory coming out, and what will happen is my inventory balance will be based on these upper layers. Okay, this is the balance in the inventory account, and under LIFO, remember, the inventory balance is going to be based on these lower layers, the inventory cost, what I have wrapped up in it. And so anyhow, hopefully that helped you get the mental model, of cost flow. So let's get back into presentation mode and move forward. These are pictures that I just pulled off the internet to give you examples from real life as to what might represent the LIFO or FIFO, and your book also talks about specific identification. And this is, I think this is coal here. Maybe you have a coal-fired stove outside the building, and if you have a pile of this stuff, you're going to be shoveling off the top of the pile. So this actually represents, in a physical sense, the last in, first out kind of a flow. Now, this nice lady here is doing what I see a lot of people doing in grocery stores. I even do it myself. And what happens is, even though the grocery store, I guarantee you, is stocking this on a first in, first out, and you go into any grocery store, you're going to find that the stocker has put, that's S-T-O-C-K-E-R, not S-T-A-L-K-E-R. The stocker has put the items that the store wants to get rid of, they put it out here on the front, and they're going to have the expiration date that's about to happen, because those gallons of milk have been maybe in the store for a few days, maybe a week. And back here in the very, very back, you'll have the more recent stuff that the store got in, and it has a later expiration date. So what most people do, I don't know if it's exactly what she's doing here, but you're reaching in toward the back to grab that most recent, freshest gallon of milk and put that in your cart, because you don't want the spoilage happening in your refrigerator at home. So what the customer is doing is basically a physical flow that mirrors LIFO, even though the store wants to follow a physical flow of first in, first out. And then specific identification is probably the easiest thing. And of course, something like an automobile is going to have unique features, where I want to say the amenities, if you will, leather seating and stuff, and so that's going to add to the cost as well as add to the selling price. But you're going to identify that, and that automobile is identified with a serial number, so you've got a record of exactly what that item costs. And so when you sell that car, then you'll have a very accurate picture of what the profit was on that specific car. Remember that LIFO and FIFO are cost flow assumptions. You have to make an assumption in order to develop the cost or expense that you will, which is expense and cost are synonymous, that you will charge or debit. The word charge means debit in accounting. Debit to cost of goods sold when you sell your inventory and create revenue. And thus you are matching revenue with expenses, satisfying the matching principle we talked about in the other slide, or in the other presentation. In this accounting discussion, LIFO and FIFO are not assumptions regarding the physical flow of inventory. That is not what they're about. You can have the mental model of physical flow, that's okay, but what this is all about is a cost flow assumption in order that you can determine what cost of goods sold and your ending inventory balance are at the end of the period. Said another way, you can have something that physically flows through your business in a FIFO manner. An example would be a highly perishable inventory like milk in a grocery store, so that you sell the oldest items, those that first came into inventory, before you sell the most recent or freshest items. If you elect to use a LIFO cost flow assumption, even though you likely are selling on a first in, first out, which would be your earliest, the FIFO inventory as you move through time, the cost of these inventory items that you're charging to cost of goods sold is based on the most recent, i.e. the last or latest price that you paid for the inventory. And that means to say they are not being based on the first or the earliest price you paid for the inventory. And again, we're talking about LIFO. This very simple illustration shows you that when you purchase, in this case we had 3 purchases in the month of May. We only bought one item each time, on the 10th, the 18th, and the 24th, but we paid a different amount for each item, $9, $13, and $14. Now, simple average is taking the $36 that we paid for our purchases, and we bought 3 items, so it's $12 per item. Assume that you sold one unit on May 30th for $20, and now depending on which unit was sold, remember we bought 3 different units. One was at $9, one at $13, one at $14. The gross profit will vary between $11 and $6, as you see here. Again, the price is $20 for the item, but depending on what assumption we use on the cost flow assumption, you're going to get a different gross profit in each case, and also a different ending inventory. This is pretty obvious, but under the specific identification cost flow method, the unit sold is identified with a specific purchase, and we already gave the example of automobile dealerships and any kind of high-end, high cost, and low turnover item. That would be the kind to use, and art galleries or jewelry stores would be another good example. Under the FIFO inventory cost flow assumption, remember the first units, those oldest units, like the first human being, the oldest human being that ever was, the first units purchased are assumed to be sold first, and the ending inventory is made up of the most recent purchases. And I'll say again that under a FIFO assumption, this mirrors what most businesses want to do. They want to get rid of the old inventory for fear of obsolescence or fear of spoilage. They want to get rid of that first inventory, and so at any period end, what they want to have in inventory is the most recent purchases. But again, that's talking about a physical flow, and you got to divorce yourself of that physical flow mental model when you're and just say we're talking now about just a cost flow model, and go from there. Excuse me, I think I just skipped a slide. Under the LIFO inventory, the last units purchased, the most recent units purchased, are assumed to be sold first, and then your ending inventory, what you have left on your shelf, will be made up in a cost sense of what you paid for those earliest items. Okay? And weighted average is just exactly what we said. And remember, the cost of units sold in the ending inventory is a weighted average of all the purchase costs during the period. Remember in an earlier slide we distinguished between perpetual and periodic systems. What we're going to go through now is an illustration using a perpetual system, and we will illustrate our cost flow assumptions and how we account for those under a perpetual system. In this illustration, we're going to start with 1,000 units that we had as our cost $20 per unit. We had 3 sales during the month, on the 4th, on the 22nd, and on the 28th. Each case, we sold the units for $30 a unit. Thank goodness we're selling it for more than it cost us, right? But during the month also, we purchased units to replenish inventory. On the 10th, we made a purchase of 500 units at $22.40, and we made another purchase of 600 units at $23.30. Notice there's been inflation. So our supplier is charging more as we go through time. We're keeping our selling price level. Now let's see how we account for our inventory and our cost of goods sold under a FIFO method. This slide looks very busy, but what we're doing is simply showing our purchases here, and we made the two purchases, remember. There were our unit costs. In these columns, we're showing those sales. Remember, we made 3 sales. Each of the sales were made at a selling price of $30 each. But what do we assign as the cost of those units that we sold? We sold 700 units on the 4th, remember. We sold 360 units on January 22nd, and we sold 240 units on January 28th. This table simply illustrates that unit cost that we're going to assign to those sales. And then what's over on the right-hand side is a perpetual balance, a perpetual accounting of our inventory, and hence the word perpetual system. And we're going to use a FIFO assumption. So if we start out with 1,000 units, and the very first thing that happens is we sell 700. Well, this is pretty easy because we had 1,000, all those were at $20, so obviously we're going to assign that cost of $20 to those 700 units, and hence the $14,000. The $21,000 entry here is simply to record the sale. Remember, credit sales to increase it, and we create an account receivable, which is an asset, for $21,000. The $14,000, again, is the 700 units at $20 cost. Now, this next transaction simply adds a layer of inventory, a layer of 500 units at $22.40. That's depicted over here. Now, how did I get down to 300? Well, that was the original amount or quantity of 1,000 less the 700 we sold to get down to 300. Now, at this point in time, after the purchase of 500 units at $22.40, I have 2 layers in my inventory. One layer valued at $20, the other layer valued at $22.40. Total value of $11,200. Now what happens? I make a sale. I sell 360 units out of my inventory. So what is the cost assumption? Remember, I sold the units for $30, but what cost do I assign to those 360 units? Under a FIFO, the first that came in, these oldest units, how much do I have at that old price? I have 300. So I'll take all 300 that I had at 20, and I sold 360, so the next 60 units are coming out of this 500 layer at $22.40. So I'll assign $22.40 to those 60. And so then the sum of these 2 numbers represents my cost of sale. Okay, there's your cost of sale, $7,344. Again, it's these 2 products, and you add these 2 numbers together, and that's your sale. The 10,800 is simply the 360 units times the $30 selling price per unit. Now, what do I do next in my business? I have yet another sale. And how many units did I sell? I sold 240 units. Where did they come from? Well, all that I'm left with is this one layer at $22.40. So that's where I take them from. I take them from this layer, and it reduces that sale of 240 units from this 440, leaves me with an inventory of 200 units at $22.40. And of course, the sale of 240 at $30 per unit gives me the 7,200, so there's that entry. And then the cost of sale is the same 240 units at the assumed cost, which was $22.40, and that's where my $5,376 comes from. And now what do I do on the 30th is I create another layer by making a purchase at $23.30. And so there you see that layer coming in and valued at $13,980. So my ending inventory balance is the sum of these two numbers, which is $18,460. And then the cost of goods sold, if I just add this column, as I made my sales under a cost flow assumption, first in, first out, this is what ended up as my cost of merchandise sold, cost of goods sold, which is an expense, and it's matched against that revenue. Now remember, revenue is simply they were all sold at $30 each, so the revenue is going to be this $21,000 plus this $10,800 plus this $7,200. Now let's move on and take the same exact information, but now run it through an assumption, a cost flow assumption of last in, first out. And hopefully this will give you clarity then on what we're doing. It's the same events that happened in the business. All we're going to do are assign different cost to that inventory as we sell it, and we're going to make an assumption that these items are going to be based on the most recent items that we bring into our inventory. So let's walk it through. We again start out with 1,000 units at $20 each. We have the sale of 700, so that's going to be the same under both scenarios, because you have the only place you have to get those is in that layer of 1,000 units. The next thing we do is we make this purchase of 500 units at $22.40, and we bring those in. Now we're sitting here with our 300 units at $20, the 500 units at $22.40. Now here's where you need to pause and think about what happens and how this is different from LIFO. So what's the next event? I'm going to sell 360 units. The key question is, where did I get those units? Not so much physically where did they come from, but I'm going to make this assumption about my cost flow. Now this is the last in, is the first out. So the most recent layer that I have to pull from is going to be the 500 units at $22.40. So this 360 is all coming out of this layer at $22.40, and that's what I'm going to charge to my cost of goods sold, is $8,064. And now what did that do if I assume this 360 came out of this 500? Well, look, I'm still left with the 300 from way back when, this old stuff. And I've now eaten away at this 500 layer, and I've got 140 of it left at $22.40. My inventory balance is still the same under LIFO or FIFO, and I said inventory balance, excuse me. The quantity is still the same under FIFO or LIFO at this point in time, which is going to be 340 units. Let me prove this to you. Let's go back to the previous slide. And there is, excuse me, I maybe made a liar out of myself, because the balance is 440. Hang on, let's move forward one. Oh, it is 440. I just can't add, I'm sorry. So yeah, there's your 440. It's just my cost is going to be different, my unit cost. Now we have a sale of 240 units on the 28th. Where do I get these from a cost flow assumption? Now under LIFO, I'm going to take the most recent items. Now the most recent layer I have is this 140 units at $22.40. So that's what I'm doing here, is taking all of those 140 at $22.40. Now I sold 240 units, so the other 100 are going to now dip in to this layer that I had, the 300 units at $20. I'm going to dip in 100 of those and be left then with the 200 units at 20 bucks. Okay, so I had a sale of 240 units at $30. There's my AR of 7,200 and my sales revenue of 7,200. Now this cost of goods sold is coming from right here, because I had to take from my most recent layer that I had, because that last in first out. So I'm going to look at that most recent stuff, and all I had to pull from was that 140. So then that left me with 100 to pull out of this layer here of 300 at $20. Now, the last thing then that happened was I built this layer, added a layer of inventory of 600 units at 23.30, so that's where they are. And so now my ending inventory balance under a LIFO assumption is 17,980. Cost of goods sold was 27,200. Now I'm going to pause and throw something at you, and you're probably thinking it's like drinking out of a fire hydrant at this point, but I can tell you this, and I've worked in inventory. I grew up as a young CPA in the Southeast in South Carolina. I audited a lot of textile companies, and so I know what the raw material, the cotton, and some of their finished goods. Some of these people made T-shirts and other articles of clothing for different department stores. And I can tell you this, that when you have inflationary an inflationary economy, the prices are rising on your raw materials. LIFO will always give you a higher cost of goods sold and a lower inventory balance compared to FIFO. So in inflationary times, LIFO will give you that higher cost of goods sold, and that's why a lot of companies will elect to use LIFO for tax reporting. Now, just to show you that I'm not lying to you, remember this is LIFO, and our cost of goods sold was 27,200. I'm going to flip back to the previous slide, which was FIFO based, and remember, in inflationary times, this is inflation, the prices are going up from 20 to 22.40 to 23.30. So under LIFO, I'll have a higher cost of goods sold than I do under FIFO. This was FIFO, 26,720 versus 27,200 under LIFO. Now hopefully that made sense to you. Weighted average cost, what's that all about? Well, under weighted average, in a perpetual system, you compute an average unit cost each time that you make a purchase. The unit cost is then to determine the cost of each sale until another purchase is made, and then you compute a new average. And thus it's also called a moving average. Now, this illustrates what happens using the same data and the same tabular format as we had under FIFO and LIFO, except now we use a weighted average cost. And as you might expect, you're going to end up with a number kind of in the middle between what you got under FIFO and what you got under LIFO, because it's going to be blended. And so you start out with your 1,000 units at $20. You're adding a layer here. You're selling from this layer, so you're selling the 700. So that's the same under every system that we had. Now, each time you make a purchase, you're now going to compute this new average. So you bought 500 at 22.40. Now you've got an average because you have 800 units. And how much money do you have in them? Well, you've got some at 20, some at 22.40. The weighted average between these two units is the 21.50, and I'll leave it to you to do that simple math to figure out how they got to 21.50. And then you have these sales, the sale of 360 items, and then about a week later a sale of 240 items, and you're pulling those out at that weighted average. Remember, you only compute a new weighted average when you make another purchase. And that's what happens here. You purchase 600 items at 23.30. Now you're going to have to average that. You have a 21.50 at 200 items. You have 23.30 at 600 items. Blend those together with an average, and you get to $22.85. And then what you do is use that to value your ending inventory, which is 18,280. End up with a cost of merchandise sold of 26,900, which is basically, if you're going to add then the three numbers here, this sale, and this sale, that'll give you your 26,900. So now we're going to shift gears and look at a periodic system, and again using FIFO, LIFO, and weighted average. The previous slides were somewhat in depth, somewhat busy, explain the perpetual, and now we're going to talk about periodic, which is really a much easier and simplistic concept. And in this case, you had an inventory. There's your same beginning inventory of 1,000 units at $20, and then your purchases 500 units, 600. So all this is the same. Now this is when they say merchandise available for sale. If I move into a mode here of Let me go into an edit mode so I can do a little bit of drawing for you. I just can't help myself. I love to do the drawing. Sorry about that. I want to move up. Here we go. So this kind of a mathematical model is helpful for virtually anything in accounting. If I take in any account balance, if I take my beginning balance plus, we'll call this, in this case, we'll call it purchases, then I can get a subtotal which is equals goods available for sale. Now, if I then subtract from that my ending inventory, then what I will get is COGS, cost of goods sold. Okay? So the beginning plus my purchases, then that equals what I have available to sell, excuse me, and then subtract the ending inventory balance, and then that will give me cost of goods sold. Now, the way to illustrate this, so in this case, this 45,800 is that subtotal. Okay? So which is what they did, is they took the beginning balance of 20,000. Okay, and they added all their purchases, and these were your two purchases, right? Remember that? And then that was your goods available for sale. Now you can see, depending on what I deduct from this 45,180, that's going to give me my cost of goods sold. Now, what's going to determine the amount that I deduct? Well, I have to develop a cost, and I have to use a cost flow assumption. And so remember, under FIFO, and what am I trying to do here? I'm trying to compute the ending inventory balance. Okay, that's what I'm doing. And so under the cost flow assumption, this amount may be greater or less depending on what I'm under, FIFO or LIFO or weighted average, and that's going to have a direct impact on my cost of goods sold. This is just simple arithmetic here. Okay, let's go back into presentation mode and continue. So the physical count on January 30 showed that I had 800 units on hand, which means I sold 1,300. Remember, I started with 1,000, and then I made my purchases, okay, and then I had 800 units left. Now, first in, first out. What I'm wanting to do then is say, how do I value these 800 units? What layers do I have to value them? Well, if when I sold the units, remember I started out with 1,000 units at $20. What I'm going to value these ending 800 units at is at the most recent purchases that I made. Okay, so I made a purchase. The most recently was the one on January 30th, where I bought 600 units at $23.40. Now, if I had 800, that means this 200 comes from that next most recent layer, which was at $22.40, and that's how I get my ending balance of $18,460. Now, so if I started out, there's my 1,000 units at $20 per unit. Under all scenarios, that was the beginning number, $20,000. And then my purchases of $25,180 equals goods available, and then the value I used under FIFO, $18,460, will then give me a cost of goods sold of $26,720. And this is a picture of what just happened. And again, all this data is coming from the same illustration that we went under the Perpetual, so you can go back and refer to those slides if you're getting confused. But if you're left then with, this was a purchase of 600 to give you what's available, and so there's that ending inventory at 600 units at $23.30, and then you had, from this layer here, you had 200 units at $22.40. Okay. Last in, first out. Again, we're going to determine cost of goods sold by using just simple arithmetic and subtracting from merchandise available. This is the same number. The merchandise available is the same number under LIFO as it was under FIFO. Because what is it? It's just simply the beginning inventory plus all the purchases that you made. Those don't change. That's what you did. It's what you assume under the cost flow to get to the ending inventory balance that will then determine your cost of goods sold for the period. So how do we get this $16,000 of our ending inventory? Let's look at the picture. It's all going to come from this old layer, because the last stuff that came in, the most recent stuff that came in, was the first that went out. So the ending inventory is going to be based on this very old stuff, the original stuff, which was at $20. And so all of our 800 units that we had are at $20, so therefore the value is $16,000. When I say the value, the cost is $16,000. And then weighted average is, we're going to use the weighted average unit cost for determining what was sold. And so we just look at our purchases that happened. And so the total units available were 45,180. That also includes the beginning inventory, and so we had total available units 2,100, and that's how we get our weighted average cost per unit. We'll take that $21.51 and we'll multiply that by the ending inventory, and then simply subtract that ending inventory from goods available to get your cost of goods sold.